All right, let's dive into a powerful trading signal you've probably seen on your charts a million times, the rejection candle. But more importantly, we're going to walk through the exact step-by-step rules you need to follow to trade it the right way and to avoid the traps that catch so many traders out. So let's start with this, the rejection candle. You know the one. It's got that long, angry-looking wick sticking out the top. It's basically a footprint left behind in the market, showing us exactly where the price tried to push up, but got absolutely slammed back down by sellers. Seeing it is the easy part. The real question is, what are you supposed to do about it? And this right here is the #1 mistake, the biggest trap of them all. You see that long wick, your brain screams reversal, and your finger instinctively goes for the sell button. Acting on that impulse is, well, it's one of the fastest ways to burn through your account. But there's a much smarter, much more disciplined way to approach this. Okay, rule #1, location is everything. You've got to understand where this candle shows up on your chart matters way more than the candle itself. Before you do anything else, you have to ask one critical question. Where did it form? And here's the answer. This is the absolute non-negotiable filter. The rejection candle has to form inside or at the very least touch a known supply area. You can think of a supply area as a price ceiling, a zone where sellers have shown up in force before. If that candle appears out in the middle of nowhere, it means nothing. You ignore it, you just move on. It's a total disqualification. So let's say the location is perfect. It's right in that supply zone. Do you trade it now? Nope, not yet. Now comes the validation process. We need to wait for the market to give us 3 very specific confirmations that this signal is for real. And these are the 3 steps. This little process is what transforms a simple candle into a high-probability trading setup. This is how we stop guessing and start planning. Okay, so step 1, you're going to look at the price action just before our rejection candle formed. Find that most recent little dip, that swing low, and just draw a line there. That's it. That line is now our line in the sand. For step 2, all you have to do is wait. I know it's the hardest part of trading, but you have to patiently wait for the price to move down and take out that swing low you just marked. And we're not talking about a little poke below it. We need to see a clear, confident break. This is the market telling us, yep, the sellers are starting to take charge. And that brings us to step 3. As the price is breaking down through that swing low, we are hunting for one final piece of the puzzle. We need to see something that tells us the move down wasn't just weak or indecisive, but that it was strong and aggressive. And that final piece of evidence is called a fair value gap, or FVG for short. Now, just look at this 3-candle pattern here. See how the low of that first candle and the high of the third candle don't overlap at all? That little space between them, that's the fair value gap. It's a sign of a major imbalance. It basically means price moved down so fast and with so much force that it left a kind of hole in the market. That's our final confirmation. So let's put all the pieces together. We've got our candle in the right location, we saw the price break the swing low, and we've confirmed the move was aggressive with a fair value gap. Only now do we have a high probability setup. So how do we actually trade it? This is the moment. After all that waiting, all that confirmation, congratulations. You are no longer looking at just a rejection candle. You are looking at a valid rejection candle. It's not just a signal anymore. It's a full-blown confirmed setup. And here it is. This is the most crucial part of the entire strategy. We don't trade when the candle forms. We don't even trade when it's validated. We wait one more time for the price to pull back up and tap the level of our validated rejection candle. That retest, that is our entry. That's where the odds are stacked in our favor. So what's the big idea here? What's the major takeaway? It's all about shifting from just reacting to a pattern on a chart to patiently executing a complete rule-based plan. It's about moving from guessing to following a strategy. So think of this as your personal pre-flight checklist. Before you ever risk a single penny, you just run through the list. Is it in a supply area? Check. Have I marked the swing? Check. Did price break that swing? Check. Was an FVG created? Check. Okay, now I can wait for my entry. This simple checklist is what protects you from making emotional, impulsive decisions. And really, in the end, every single trade you take boils down to this one question. Are you just guessing and hoping for the best, or are you following a proven plan? This is what separates the consistently profitable traders from everyone else. And now, for this one specific setup, you have a plan.